Hey guys, welcome back to the channel. I'm Luke, a CFA Charterholder. Today we're going to be discussing a topic from the corporate issuers section of the level 1 material, and that is contrasting public and private companies. We're going to run through some of the features and contrasting characteristics of public and private companies. So yeah, let's get into it. Okay, so an important distinction between corporations and companies is whether they are public or private businesses. So when you think about the different types of organisational forms that you study within the level 1 curriculum, you've got your sole proprietorships, your different types of partnerships, and then your companies. So your companies can either be public or they can be private. As if a company is public, they're commonly known as being listed, or if they're private, they're also known as being unlisted. So let's start with public companies. Let's quickly define it. So a public company is one whose shares are held by a large number of investors, and importantly, this is the important point, and are traded freely on a listed exchange. So there's an active market for the shares. There's liquidity, there's an open market where market participants can buy the shares and sellers can sell down or exit their positions, and can be bought or sold by anyone at any time. So the shares are available to the general investing public. There's significant liquidity, there's price transparency, volume transparency, and there's an active liquid market for a public company's shares. Whereas in contrast, a private company is one whose shares are typically held by a small, often very small number of shareholders. And this can often include founders, managers, venture capital firms, private equity firms, institutional investors, and are not freely available to the investing public to buy or sell. So yeah, private companies' shares are typically owned by the founders and the executive management team, and any sort of venture capital, private equity firms that have provided early stage growth capital to the firm to help them grow. You're not going to see shareholding that is available or held by public market investors. So the general public aren't going to be investors in a private company, but they are investors in public companies. So that's kind of the main distinction between the two types of corporation. So one thing that I think that is slightly confusing in the curriculum, and I wanted to flag here, is that the concept of public versus private companies differ slightly to the discussion regarding private limited companies versus public limited companies. Most public companies you'll find are structured as public limited companies, but not all public limited companies trade their shares on an exchange. Most public companies that exist are structured as PLCs, but not all PLCs trade their shares publicly. They could still hold their shares privately amongst a small group of shareholders with an infrequent amount of trading taking place. So let's kind of illustrate this. So we have two types of limited companies. We discussed this in the organisational form section of the material. You have private limited companies, and you have public limited companies. Now here's the distinction that's worth being aware of. So shares in private limited companies can be privately held or privately owned only. So private limited companies cannot have shares that trade on a listed exchange, whereas public limited companies can be privately owned, i.e. their shares can be held amongst a small group of shareholders, founders, VC firms, etc., or they can be publicly owned. Public limited companies can be privately owned or publicly owned, whereas private limited companies can only be privately owned. Bit confusing. I think the curriculum is slightly unclear on this topic, but that's a really important distinction to be aware of. Some other distinctions that are worth knowing in terms of contrasting public and private companies include the ease of transferring ownership between different market participants is significantly easier for public companies, as the shares are highly liquid, there's an active market for them, and there's high price and volume transparency. So there's a liquid market created by an exchange. There's a share price, a volume weighted average price. There's a lot of volume data out there in terms of how many trades are made a day. Buyers and sellers have a lot of information, which allows them to make buy and sell decisions into the market. Whereas private company shares are very difficult to transfer because you need to find a buyer and there's not an active market. So where do you find a buyer? You need to have a good network of investors and make cold calls and cold emails. It's not easy to find an investor in a public company because there's not a centralized venue like you have when it comes to public stocks. And also a valuation of a company needs to be undertaken. And this is, again, time consuming and difficult to do because at least with a public company, you have data points. You have a share price, which is a market valuation. You have historic prices, so you can see how that share price has evolved. Whereas private companies, you've got nothing. You've got to build a model. You've got to do loads of due diligence to understand the business. There's nothing really out there to help, inform the price or value of the company should be. There's no live market price. There's no data on a Bloomberg screen. They don't prepare quarterly reports, so you've got limited financial data. So it's difficult to undertake valuations of private companies if you're an analyst. In terms of issuing new shares, the process of issuing new equity and raising additional financing is much more straightforward and quicker for public companies because they can just raise funds in the public markets. They can go out to the general investing public, institutional investors, pretty much anyone, and raise capital. Whereas private companies have no access to those markets. They've got no access to the public market. So they have to raise capital through private placements. So that's private equity raises, private debt raises, through institutions. They've got no access to the broader equity or debt market. Access to additional capital. This kind of follows on from the last point. Both debt and equity capital is much more accessible for public companies than it is for private companies. The size of the public market is larger than the size of the private market. So for companies that are looking to raise large pools of capital, being public will be able to provide greater and larger sources of funding than the private market. And then finally, reporting and disclosure responsibilities. So regulation, disclosure, reporting are all significantly higher for public companies and also much more costly. So it's more time consuming. You've got to get it right. You're reporting to regulators. You've got to invest more in your auditors, in your investor relations teams, in your controls. You're reporting to your public investors, your regulators, your governments, and you come under a lot more scrutiny. So your disclosure has to be comprehensive and has to be correct. You have to disclose quarterly and annual earnings and material matters to investors. So if anything is important and is pertinent to investors and they need to be made aware of it, then public companies are under much more scrutiny to disclose. Whereas private companies don't really need to disclose much at all. They don't need to disclose their financial performance, and they don't really need to disclose material matters. They can do if they want to. So for example, if they want to negotiate better terms with their investors, they will often offer to disclose certain financial items or results, again, to help them negotiate better terms with their debt and equity investors, but they're under no regulatory requirement to do so. They would do so voluntarily. So yeah, reporting and disclosure requirements are significantly higher for public companies than they are for private companies. So yeah, that's everything I wanted to discuss. That's a brief whistle-stop tour through public and private companies. We've contrasted the two. We've looked at how they differ. So yeah, any questions, feel free to fire them off in the comments, and I'll see you guys in the next video.